This is easily going to be the most jam-packed video you have ever watched when it comes to trading education. I have packed in every single thing that I think is necessary for you to become a profitable trader and go from 0 to 10k in a matter of months. I've just had my first £10,000 month from trading, and now I'm looking to share my knowledge. In this course, you'll learn the very basics to an entry model that will make you thousands of dollars. There are many courses online, but this one compacts everything into the most efficient way possible for you. Honestly, I wish I had this when I first started trading. Make sure you have a notepad and a pen and you are taking notes, because this is the most source-filled video you will ever watch. So let's begin. I hope you enjoy the video. First of all, guys, you need to understand what TradingView is. Now, TradingView is where you'll see the chart and basically place your trades. So you need to download this, and for this, we need to go over to More, Downloads, Desktop app, and then choose whichever one you would need. Once you've downloaded TradingView and you open it up, this is what it will look like. It doesn't look too pretty, and you're going to want to change a few things. First of all, what you're going to want to make sure is that you have your time down here set to New York. So that's, at the moment for me, is UTC -5. So we click that, and then you'll be on the same time stamp as New York. So let's clean up this chart, and I'll go through my settings with you guys. So first of all, let's get rid of the volume. So we want to remove that, and then we double click on the chart to bring up this. Okay. For this example, also you can come over here, and in the top left you'll have the 3 lines. You can change it to dark theme to white theme depending on what you'd prefer. For this, I'm going to use dark theme because it's blinding me. So we go dark theme, double tap on this. This is how you can change the bodies of the candles. Now, changing the bodies of the candles is really good, because if you see red for down and green for up, those have some negative connotations with them that will affect your emotions overall. So you want to really dull the charts down, to be honest. So first off, let's get a grey and black chart, okay? So we want to do the bodies. Let's go with like a light grey, and then with the down candles, let's go with a darker grey, okay? And then for the wicks and border, I'm just going to put that as the second one in as black. Okay, so now you can see this looks kind of weird. Now on to the next thing. You want to go to status line. These are the settings for status line that I have. And then scale and lines, you just want to leave these as they are. Obviously you want to have countdown to bar close on. That's very, very important. And then the value line, you can change to whatever you'd like. Let's, for example, we'll change it to black for this one. Okay, and then we go to canvas. Now this is the back, like behind the chart. So all this space here is the canvas. So we want to have a solid background, or I do anyway. And I want to have this like a light gray. So for example, like this, okay? Now you can see we still have the vertical and horizontal lines. So let's get rid of those. And now we have this. Very, very nice, easy to read. I'm also going to make the text and crosshair darker because I actually can't see them very well. There we go. So now we have that set up. Perfect. This is a beautiful looking chart. Okay, so once we have this chart, what do we have here? This is the list of basically things you can trade. So you have stocks, futures, forex, crypto, and indices. Now we're only going to be using futures with this. So we're going to be trading futures. So let's get rid of all of these. Boom. So how do we actually get the indices up? So if you literally just type it in, and what we're going to be using is NQ. So this is the NASDAQ futures contract, okay, by CME. So you just want to click that, and you will actually have data is delayed, and we'll go through that in a second. But for now, to add this, you want to go up here and you see this little check mark, just click that, okay? I can't do it right now because I'm not logged in to show you guys the run through, but yeah, this will, that's how you do that. And then you can sort it, stuff like that. And we are trading NQ and ES. So these are 2 futures, or indices that you'll be trading. Now, you mainly want to focus on NQ, or which most people do, and I do personally as well. So to get rid of data is delayed, and to actually get the correct market data at the right time, you want to go to back to the TradingView homepage, products, market data, and you want to scroll down until you find CME group, right? So this is £7 a month, and you get access to all of the futures. The S&P 500, NASDAQ, Russell 2000, all of the ones you really need, which we only really need NASDAQ. So that's what you'll need to also buy. But if you are trading with fundeds, which I don't expect you to do right away, then you will actually get that with the package you pay for the funded. So you don't need to worry about buying that if you're trading with funded accounts. And with futures, you also have a contract rollover, which is every like 3-ish months. So to just adjust that to be on the right contract, you want to go down to the bottom right and click BADG, which basically is adjust for contract changes. So you just click that, and then you'll have the right contract at all times if you are trading the NASDAQ. Then you are going to want to have 2 charts up on your screen. Now for this, you are actually going to need to pay for the basic plan, I believe. Let's find this. So products, pricing, and the essential plan even. So the essential plan is what you'll need to have 2 charts. What we'll use this for is SMTs, which I'll go over in a bit more detail later on. So with this, you get 2 charts per tab, 5 indicators per chart, 10K historical bars, 10 parallel chart connections, 20 price alerts, 20 technical alerts, and 20 price alerts, by the way, is actually really convenient. That's actually really good to use. No ads, volume profile, custom time frames, custom range bars, multiple watch lists, bar replay, and indicators on indicators. That's what you need. That is pretty much everything you'll need to get started. Also, just another thing I just realized, electronic trading hours background. If this is up, then you can just take that to 0. The indicators that I use 3 indicators, and I use equal lows and highs. There we go, by out of options. Now what this does is basically show you when there are equal highs or lows created within the market. You can see here, these are equal highs in the green. I don't know if you can see that. And after that, we also have, let's see if we can find some equal lows to show you. Well, there we go, some equal lows here. And the second one is ICT kill zones and pivots. So you want to just add that, and it will look something like this. Now for this next part, I am going to switch to my normal chart, because this one looks very foreign to me and I don't have to worry about all the paid things. So let me just switch over. Okay, so here we are with the ICT kill zones and pivots. Now the settings you want to use for these: Asia 8 to midnight, London 2 to 5, New York AM 9:30 to 11, and New York lunch 12 to 1, New York PM 1:30 to 4. There we go. There's the box transparency, text transparency, and all the other settings here. Pause it if you need to. Don't use any of these. And that's that. This will basically show you where the sessions are, and sessions are good for the use of liquidity, which we'll get into in a second. But it's just good to know where the market has actually traded overnight. So now that you guys have set up your charts, now let's get up how to actually place a damn trade, okay? So top right, you wanna click trade. Now you come to here and it looks a bit confusing, but we are gonna be using paper trading for now, okay? We'll get into the others in a bit. Now here, let me just turn executions off. So here you can see you have this little bar come up here. Let me move my camera real quick. Here we go. So you have this little bar on the side come up here. Now what you want to do is if you click buy and sell, and then you click sell 1 NQ contract, that will just put you straight into the markets, okay? That is a market order, right? So let's get out of that. Close position. And if you want to set a limit order, if you want to set a limit sell, you want to put the limit above price, and if you want to put a limit stop, you want to put it below price. So if you are sell stop selling, then price will come through on its way down to actually tap you in and continue, or if you set a limit, it has to come up first to then get you in sells and then move down. Okay, so market will get you straight in, limit will get you in soon, and then stop will get you in on its way. Okay, same for buy. Buy, if you want to get in with a limit, you have to put it below, and then stop, you want to put it above because you're buying into it. Do you know what I mean? Okay, so that's how you do that. Now let's see what is a stop loss and take profit. Okay, you have ideas in the market of where you want the trade to go, and if it doesn't play out, then you're pretty screwed if you don't have a stop loss, because you might lose hundreds if it just carries on running. You think it's going to turn around, No, you need to have a stop loss to actually tell you when the trade is invalid and then take you out of the market. Right, so let's say we put in a buy limit. Let's put in a buy limit here. Looks like it's going to tap us in quite quick. There we go. And our stop loss at this low, sorry. So this means if price comes all the way down here in our buy position, then we will sell our position and get out with a $525 loss. Okay, so we confirm that, and that is our stop, because price could come all the way down here and then we lose way more than that. So you want to be risking appropriately, okay? And then take profit is where price will, take you out of the market to take your profits, right? So let's move those closer and I'll show you what that means. So let's hit the stop here. If I move this closer, there you go. This is my stop loss and price can come down and stop me out, hopefully. This is how you put executions on as well, by the way. There you go. So you go trading and then execution marks. So then you can see whereabouts you've actually traded, okay? So that, you see there, we bought in here and we got out here. That was my stop loss. Perfect. And that gave us a loss. This is an old account. If you want to start a new account, you want to go to settings, reset account, and then balance. You want to be doing it with a 50K. That's what people mainly go for when they first start. So 50K and leave all those the same, click reset, and then you'll have 50K. Okay. So then we want to place a buy with this 50K, market buy. There we go. Stop loss here. Take profit here. There we go. That's your trade. So you're anticipating the price is going to come up here before it goes on here. But if it does go down here, it's not a problem. Okay. Right. Let's get out of that. Close position. And then you can see the executions are there. So our first proper lesson is candlesticks. Now, candlesticks are literally how to read the chart, and they will show you all the data you need to actually place trades. So let's get straight into it. So on the green candle, you have a bullish candle. This means it's going up, right? And on the right, we have a bearish candle, which is red, which is going down, okay? So with the bullish candle, we open here and then price comes down. We then move up. We come up to here and then price closes here. Now this might not be like this, very obvious, but this is just what price has done within this candle, okay? And with the bearish, you have the open here. We move up, low, close, okay? Now this doesn't mean this has to be the way it did it. We could actually open here. We could actually then come all the way down, then all the way up and then down again and then close. So you have that candle still here. Let's draw this out the best I can. But you still have those wicks when actually this is what it did. So yeah, that's just how to read the candles. Take that in, put that in your notes. Yes, let's continue. Now, each candle actually represents a time frame. So this could be 1 minute and this one could say be 15 minutes. Oh, that's not very good. There we go. 15 minutes. Now, what does this mean? So this candle represents 1 minute of time, okay? And so in 1 minute, price has done this. Okay, so price in 1 minute, we opened, we came up here, we came down here potentially, and then we closed here, right? There we go. And in 15 minutes, this is what price has done. So let's say we open here, and then in the first 5 minutes, price comes up here, and then in the next 10 minutes, price comes down here and then closes here, right? That represents 15 minutes. This represents 1. Now, if we go to the chart, you can see here in the top left, you have all of these different time frames. Now, each one doesn't matter yet. We'll get into that a bit more. But as you can see here, we click on the hourly, for example, and this is an hour's worth of price action. So this is a bearish candle. So price has opened here, come up and come down, come back up and then close here, right? Simple. 30 minute, same thing. 15 minute, same thing. 5 minute, same thing, okay? So if you have a 15-minute candle, there will be 3 5-minute candles within this. And if you go even to the daily and weekly, for example, each candle shows a week's worth of price action. So with this week, we opened here, came down a little bit lower, and we closed very high up. So that was a very bullish week. Daily, same thing. Another important concept to understand is that wicks will do the damage and bodies will tell you the story. What this means is price could wick out, take something, but it does not mean we are bearish. It means we have maybe manipulated and then price is closed above, which means actually we might want to go higher. So that is the story. So you really don't want to be paying too much attention to the wicks unless it is like taking out a good chunk of liquidity, which we'll go into in a second. Don't worry. Once again, I'll go over this. So green candle or white candle for my example, for your charts, will be bullish and then red bearish. Bearish means down, bullish means up. Long, short, long means buy, bullish, and then bearish means sell or. So that's everything for candlesticks. Make sure you guys are getting these notes down and revisiting them to understand fully how this sort of works. And then once you've got this down, let's head on to the next concept, which is market structure. I hope you guys are excited because this is a good one. Second lesson, market structure. Let's fucking get it. The two main types of market you want to focus on and the other you want to avoid. The two you want to trade are trending markets and you want to avoid a consolidating ranging market. So these two are trending markets. This one is a consolidating market. Price in a bullish market structure is making higher highs and higher lows. Okay, so as you can see here, we come down, boom, 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 very nice, clearly uptrend. Okay, bullish, buy, long, that sort of thing. Bearish market structure, we are making lower lows and lower highs, meaning we are doing what? This. Very, very clearly trending down. Now, don't worry, guys. I'm going to show you some real life market examples, so do not worry. That will clear things up a bit, I think. So here in a consolidating and ranging market, price is not very clear. It's not very obvious, so you don't really want to be trading in here because you cannot really have a strong bias. So like here, for example, boom, 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 boom. Like like how are you even going to trade that? Do you know what I mean? So that is that. Next. Can I just spacebar this? Oh yeah, we can. Now we need to move on to time frame importance. The higher time frame is the more reliable trend. Time frames within market structure are very important. You want to use it to your advantage to determine where a trend might change or even continue in the direction it was already headed. As you can imagine, a continuation of a trend on the higher time frame is a much larger move on the lower time frame. Okay, so here we have macro versus micro. What does this mean? Macro, we have 1 hour. So macro being bigger time frames, micro being smaller time frames. On the 1 hour, you can see we have this clear bearish structure, but on the micro time frame, you can see we have this bearish, then we have bullish, then we have bearish, then bullish, then bearish, bullish, bearish. So we have small trends within larger trends, okay? So here you just have bearish, retracement, bearish, retracement, bearish. But these retracements on the lower time frames are actually structure that you can profit from. As you can see, the higher time frame has an obvious trend where the lower has smaller micro trends, which you can benefit from. Perfectly explained. How to anticipate trend change. Now, when you have a view of a higher time frame trend, you can use a higher time frame PD array. We'll get into that to anticipate the change or direction and get the confirmation from the lower time frames. Now, how do we confirm a trend change? Trend change can be anticipated using lower chart market structure shifts. What the hell is a market structure shift? You might be asking. Well, do not worry. I am going to tell you. So first of all, an important addition to market structure shifts. When you are looking for a market structure shift, it must firstly occur in a place you expect it to. And secondly, it needs to have good displacement. If there is bad displacement, you could be faked out by a liquidity sweep. Good displacement means long candle with nice body, right? Big candle, good displacement. Small candle, bad displacement, okay? So bad, good, right? Displacement is literally just the length of a candle basically showing how strong it was, okay? So here you have good displacement. You can see we displace really nicely past this low. And then here with bad displacement, you can see we just tap above it, meaning this could be a sweep and then a reversal. When do we expect the market structure shift to actually occur? So the market structure shift occurs when we hit PD array. So you can see here, and this is the 50-minute time frame. We trade into a 1 hour fair value gap, which is a PD array. Don't worry, we'll go over them. And then we shift market structure. So we have a market structure shift here. Now, market structure shift is where price will close below or above a previous manipulation leg, okay? So here you see we come up, we manipulate this high, and then we trade below it with nice displacement. This is our market structure shift. So then we have break of structure and CISD, which is changing the state of delivery. Now, they're both really important to know, but you're not going to use them as much as some of the other concepts in this course. So let's get into break of structure. A break of structure is essentially just a continuation of the trend. Here is an example of break of structure and a good versus bad break. So here you can see we have a bad break where we just close above. And here we just close above, which could have been a sweep. And then obviously we do actually disrespect this low because we only swept that high. But here you can see good break of structure. We come up, we have a nice move up, and then we respect this. Same here. in this scenario, we have a nice move up and we respect that, and then we have that sweep or bad break of structure, and then we move down. So that is break of structure. Changing the state of delivery, or CISD. A CISD can be seen as an order block. What this actually is a market structure shift at the manipulation leg body close of the last opposing candle before a market structure shift. So that sounds like a load of words thrown together, and trust me, I'm aware of that. But it's actually very, very simple. So we have here the manipulation leg. So this is a high, and then we manipulate this high. 1 second, there we go. So we have this high, we manipulate this high, and we close below the last up close candles before that change. So you see here, we close below these up close candles that cause the manipulation leg, and that is your CISD. And as you can see here, it actually works as a really nice rejection point. So you see, we come up, we actually tap the CISD here that was formed before, and then we reject nicely. Okay, and then here again, we have a really nice manipulation here, and then we have a CISD here, and then price comes back in, trades into there, and then we move off that. So that is that. Now let's go into some chart examples. So I'm on the 15-minute chart here, and we're going to look for some CISDs to show you, and just some market structure shifts. So here you can see, let me get my brush out. We are number one, we have this manipulation here. This is a market structure shift. No, CISD even, change in state of delivery. So we have that manipulation, we close above here. Then what does price do? We come back into it and we reject pretty damn heavy off the CISD. Now let's go into the trends. So we have a boom, 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 boom. Very clear uptrend. And then we have this boom, 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 and that structure shift. Now I prefer to use the manipulation leg as a structure shift. So realistically, when we came down here and closed below this with nice displacement, this is my market structure shift rather than this, because some people will use this as a market structure shift, but actually I would like to see this be the manipulation leg to then shift here. Here again, another one, you can see we come up, we manipulate this high, and then we close below the low that caused the high, which is this one. And that holds very nicely to push us down. Let's see if we can find a bullish example. So here you can see consolidation. This is where you would try to avoid trading as it's not very clear. And our bullish example, again here, we come down, manipulate. I don't know how I've switched to that. Manipulate, market structure shift, and then we come down, respect this market structure shift, and then move up. Okay, very, very simple. And very, very easy to understand. This is an example of the structure with a fair value gap as well, so PD array. So we're expecting price to reject from somewhere. Price, we manipulate, we have that structure shift, and we also form a 1 hour fair value gap here. So we mark this out like so, and then what we expect is for price to come into here and then react off of that after our market structure shift. So we also have a nice target here. Let's see. So do we get that market structure shift off this? There we go. We come in, we've got a 5 minute. This would be our market structure shift here. We go market structure shift, then we could potentially look to catch longs or even just enter off this market structure shift. Okay, so that is pretty much the idea. So you're looking for a reaction on a higher time frame for then a lower time frame trend change, okay, with the market structure shift or CISD. Another side note on market structure is that you want to really reverse engineer your trades when you're using structure. Let's say, for example, you have a nice bullish market structure. Here we go, boom, boom. And you want to look for longs in this structure. So you first find the trend and then you find the entry, right? Now we have liquidity. Now this is arguably one of the most important lessons of this course. So notepad and pen at the ready, boys. Let's get into this. What is liquidity? The market needs orders to move, and that is the bottom line. If a large order needs to be placed, more orders are needed. For example, if a large institution wanted to sell a large amount of NASDAQ contracts, then there has to be the same amount or a large amount of contracts looking to be bought. This is where the concept like liquidity sweeps come into play. So you've heard about me talk about this throughout the course. Now you guys are learning it, so pay very close attention. If there are not enough orders for a large institution to place their order, they will seek liquidity or orders in order to be able to place their order. I came up with this marble metaphor. 3 people, John, Ben, and Sam. John has 22 marbles, Ben has 24 marbles, and Sam has 54 marbles. So if Sam wanted to sell 20 of his marbles, then either Ben or John would need to buy them. In a similar scenario, if John wanted to buy 10 marbles, then Sam or Ben would have to be selling them, or he would have to take them. If either Ben or Sam wanted to sell their marbles, the only way John could attain those marbles was if he forced Sam or Ben to sell theirs. And this is essentially what the liquidity sweep is. And John would be the institutions, and Sam and Ben would be other institutions or even retail traders like you and I. If John wanted to buy 10 marbles, then either Sam or Ben would have to be selling them to him. Now, if they do not want to sell them to him, what does he do? He has to steal them. And this is what a liquidity sweep is. It's where basically the market will come and take orders to allow bigger positions. Let's say John, for example, and they would stop out Sam's 10 orders to then be able to let John buy 10. Okay, so that's how that works. Now let's continue. How to spot liquidity sweeps. 5 main liquidity pools that I use and that are, in my opinion, the most reliable are here. So we have equal highs and lows. So this is where the wick is literally the exact same value from the tip. Data wicks, these are a news release, which basically injects a lot of orders into the market. You can see here, leaving this wick, which gets traded to later down the line. Session highs or lows. So session highs usually accumulate a lot of orders, especially if they are accumulating like Asia and London usually do. So these are also good targets or used for reversals. By the way, guys, another thing to note is that liquidity is seen as a target or potential reversal spot. Okay, so you might be targeting that as a target from your model, or you might even be looking at price to hit that level and then return. So relatively equal high or lows, this is where you don't have that tick value similarity, but they are relatively equal, as you can see here. So you can see this would be what's it called, support or even resistance in this example, where prices come up, tapped again and then gone down. So we're most likely anticipating that price is going to come up and take that level, as there are lots of stop orders above here. Now when you see a lot of stop orders above here, because people are shorting, well, in actual fact, there are also breakout traders which will also get in when you go up here. So this is where you might see a rejection. So we come up, we enter all these people that are also longing because they have traded breakout, and then we go down for that reversal. So we've hit the stops of the people shorting. We also enter the buys, and then we hit those stops as well. LR, also known as trendline liquidity, or LRL. Makes more sense for LRL, to be honest. Trendline liquidity and also support and resistance. So this is a trend line. You can see all the points 1, 2, 3, 4. We are expecting a lot of orders to be building up along here. So price, what will it do? It will come down and take these orders. So now we've got that, let's go into the market and actually have a look if we can spot these on the charts. So now we're on the charts. Well, I'm just going to go over something else, a couple more liquidity concepts. So essentially what you need to understand in the most basic sense is that below every low and high, there will be liquidity, right? Now this doesn't mean that you need to mark out these lows and highs, but you do need to mark out the most probable, which is what we've just gone over. So just to clear the air a bit. And now, second of all, I wanted to go over previous day high and low. So let's say here, you can see we are on Tuesday, so we go to Monday. You see Monday, we took the previous day high on Tuesday, and then we reversed, which is very nice. And also gaps. Gaps are very, very important. So let's say you have a new week opening gap here, then price is a lot of the time, probably 9 times out of 10, going to fill this gap within the week. So you are looking for these magnets in price also. This is where orders have been missed within the market, but we are going to go over those a bit more in detail in a minute. Here you can see price is building up a lot of LR here. There we go, and we come down and we sweep that liquidity, take up to this point here, and then we continue up. Or we can see, let's say for example, these relatively equal highs, right? Now this is only on the 15-minute chart, but it still is the same. It works the same way. So these 15-minute equal highs, you're expecting these to get traded to at some point. You just need to set those conditions to understand when, right? Now, I don't know if this is a data wick. This is not a data wick. Okay, let me I can't really find a data wick, but let me just show an example. I'll make an example here. So let's say this was a data wick, right? So we had a big news release here, and we were expecting price, because we've injected a lot of orders into the market here, price to come up and target this, which it did, and we reversed. Recently, I'm going to recent price action now. You can see that I was looking to target these for this whole entire time. So when we traded closer to these, I was looking to get longs absolutely like every single day until we actually hit these, because this is such a strong draw. We also have more over here, which also line on top of it. So this was a very, very strong draw on liquidity, and we saw that eventually, which was very nice. Something else I wanted to go over is how you can actually use it for your entry. So let's say we've got our market structure shift here, and we've got our fair value gap. So let's say we just entered off the fair value gap, for example. This would not be, what I'm teaching in terms of my model, but this is a good example. So we are looking to target this new week opening gap. So what did I say about them being targeted within a week? Well, we make it, and Monday, Tuesday, Wednesday, and Wednesday we target that. Okay, so we have that market structure shift, we then have that fair value gap formed, we take the entry into there, and we look to fill the gap. And what do? Fill the gap. So that is how you can structure your trades, looking at the market structure, and then as well as liquidity draws for your targets. That's liquidity done. Let's move on to the next lesson. Gaps. So what are gaps? Gaps are as they sound. Gaps in the market where orders were skipped. Also, bear in mind, I've just come back from the gym, so I'm in gym stuff still. I do apologize. Gaps like maggots to the market, not only because they need to deliver price fairly, but because they hold orders that large institutions can use to place orders. So essentially liquidity. They hold liquidity, they hold orders within the gaps. It's where orders haven't been filled, so you have orders resting within that. Here we have a large amount of sell orders in this big fair value gap. Here, the sell orders from the higher bearish fair value gap overpower the buy orders from the bullish fair value gap. So you can see here we push down from here, and so the orders in this fair value gap overpower the bullish in here, and then we move down. Here you can see that price came up to fill these sell orders, rebalance the market before it continued down. Okay, so we come up, fill the orders in here, and then we continue down. Now the juicy stuff. This is what I've been talking about, which you guys haven't really got. So now everything's sort of going to make a bit more sense for you. So these are the types of gaps. So we have a new day opening gap. This is where price closes from the previous day and opens higher or lower than that price the day after. So very self-explanatory with that one. And we have a fair value gap. Now, I've spoken about this a lot. This is literally what it is. Very, very simple. So a 3-candle formation that leaves a body gap between wick 1 and 3. This gap is way more common and can be seen / used every day. Here you can see we have candle 1, candle 2, and candle 3. And you see the wick on candle 1 does not meet candle 3's wick. So this basically is an imbalance in the market. Well, these all are really imbalances, and price will most likely come in to rebalance this. Now we have new week opening gap, or NWOG. Sounds very strange. When price closes on the previous week and opens on Monday higher than close price on Friday. So this will leave a big gap, and this is a very, very strong draw. You'll see this most likely get filled within a week. Obviously it can take longer, but it's highly probable. Okay, so using these as targets as well, really, really good. RTH gap, or regular trading hours gap. This is where the market actually in the US close at 4 and they open at 9:30. Okay, so that gap between the close and then the open of the actual session times for New York is what makes that RTH gap. And this also will be filled within a week. Now we have good versus bad fair value gaps and how you can tell the difference. A good fair value gap, good reaction from the previous fair value gap. This can indicate bearish order flow. So you can see here, boom, we have respected here. And so we are respecting bearish order flow, and then we failed this bullish fair value gap, meaning that yes, that's a confirmation that we are bearish still, and then we form a fair value gap here. What is this likely to do? Hold, because we closed past, so sales are stronger than buys, and we are expecting the market to fill these orders and continue down. So this is a bad fair value gap. Now we sweep liquidity, so we're not expecting this to hold. So we've taken orders, so why would this fair value gap so high up in the range hold? Now we're gonna go over premium discount as well, don't worry. So that will clear this little bit up, but we are not expecting a fair value gap to hold if we just swept liquidity. Not only that, but after we swept liquidity, if you look down as well, we also have a data wick, which is what? a very strong point in liquidity. So we're expecting price to move down to target that at some point. So why would we want to be longing from this when we have a strong liquidity pool down below? Inversion fair value gaps. This is the core pillar of the model, so listen very, very carefully. I hope you've still got that notepad out and your pen ready. Inverse fair value gaps are powerful as they indicate a change in order flow. This is because if there is a large influx of orders that were skipped and price returns and blast past them, it would mean that the opposing side is stronger than the one of the fair value gap. So all in all, the inverse fair value gap is where price closes a regular fair value gap. Now here is a couple of examples. So you can see here we have a bearish fair value gap and this one fails. Now the close, this forms an inverse fair value gap. So the opposite of a fair value gap, okay? Here you can see here as well, we come down, we take liquidity, we're expecting a bullish fair value gap, and then we have that inverse, meaning, okay, so we are still bullish because we have respected here, we've taken out what we needed to, and this basically means, okay, we're ready to continue up now, right? Now, let's go back a slide as well, because you can see it here, I imagine. Here we go. So you can see here as well, we've got an inverse fair value gap here, inverse fair value gap here, and then the bearish fair value gap holds. Okay, so a very nice change in order flow. Things to know about IFVGs. This will determine the quality of the setups you take. Number one, again, is displacement, and we have a the joke. Obviously, that I don't know why it's done that. But displacement is very important as well, just like market structure shifts. So good displacement above a fair value gap is good. You want to see that. That makes you a lot more confident. You do not want to see like if you have to like zoom in to see like a millimeter close on a fair value gap, it's not worth it. Don't risk it. So when using for trade entry, it needs to have good displacement, how far overshoots the FVG. Okay. The fair value gap has to be singular. Okay. This is very, very, very important. So if a fair value gap is not singular in the leg, do not take the inversion. Only take it if you go to a higher time frame and it becomes singular. I will go over that on the charts very, very shortly. Now, time to inverse. If a fair value gap takes more than 5 candles to inverse, I would avoid it. This is a clear indication that the market is not very strong. So if you see here, this fair value gap, we literally probably take about 20 minutes to close if this was on the 1 minute chart. So we're not going to want to take this because it's clearly not very strong, right? We want to see that near enough instantaneous inversion. Let's hop onto the charts. I'm going to show you some examples, and especially let's have a look at the singular FVG and what I mean by that. So here is a lovely bit of price action we had recently, and let's go over what my thought process was taking a trade with an IFVG. Coming into the day, we have a 4-hour fair value gap. So this, as it's a 4-hour, is more likely to hold in the lower time frame fair value gaps. And what do we have just above it? We have equal lows on the 5-minute chart, which is very, very important, and the 15. So this is a very, very strong draw on liquidity. So we are looking for price to come down, take this, and then react bullish from here. Okay. So very, very simple. Really nice day. We also have liquidity above. So we're looking for price to, once we've hit this, take this liquidity that is resting above. Okay. Right. So let's play this out. So we originally open up, take this here, make LRR here. Don't know why I said that. And then we also have this. We have that manipulation of the liquidity. We are also respecting this 4-hour bullish fair value gap. And then we have this leg. So the manipulation leg, which we want to see the inverse fair value gap form on. Now, what is wrong with this leg? There is 1, 2, 3 fair value gaps. This is on the 1-minute chart. So if we go to the 2-minute, we then have 2 fair value gaps. We go to the 3, we then have 1. But is there one on the 4-minute? Yes. Is there one on the 5-minute? Yes. So we need to wait for that 5-minute candle to inverse, or 5-minute fair value gap to inverse. So we're paying close attention to this as it's the highest time frame inversion up to 5 minutes. We need to wait for that to inverse, and then we do as so. So I took my long position here with my stop just below the fair value gap, and I was targeting this liquidity. Okay. So what do? Boom. We literally blast straight through it. Could have held for longer, but it's nice to keep that risk small so you can target the low-hanging fruit. That's always best. So yeah, that was a thought process going into that. Since we disrespected that 5-minute, that is my entire reason for going long, as it shows that we are ready to take this liquidity, and this is what we're targeting now. So we have respected the 1-hour, 4-hour, and 15 minutes, and then we inverse the 5-minute. So we are bearish on the lower time frame, we switch bullish on the 5-minute time frame, and we are bullish on the higher time frames. So now we are all aligned, and then we look to take that long, which, as you can see, plays out well. Here is also another way you can actually determine your daily bias from using higher time frame inversions. So as you can see here, we have this bearish fair value gap. Now this gets closed at above here on this day. This 4-hour candle closes this fair value gap. Now what does this actually mean? So this is like our model on the higher time frames, which I'll tell you the model, just bear with me. So we inverse the fair value gap. So now this is our target, okay? So these days, or for this time period, we are only looking to take longs to hit that target. So the failure of this bearish fair value gap means that buys are strong. So this means we are looking to target the buy side, which was this level here. And then another thing to show you, this is a new week opening gap. So as you can see here, we close on Friday and we open on Sunday. This leaves that gap and we fill it within the week. If you do have any questions, obviously, drop me a bloody comment or even drop me a message on Instagram. I will reply, and I'm happy to help you. This part of the course, boys, is about premium and discount, okay? Let's get into what premium discount actually is. So, premium discount is the two halves of a range, one being premium and the other being discount. Magic. The theory is that when you have a range, there will always be a premium and discount. If the market is bullish, you want to buy in the discount of the range, and in bearish market, you want to sell in the premium. Think of it in real life terms. When you go to buy TV and the price of the TV gets discounted by 50% the next day, you would most likely wait and buy the TV when it is discounted. Same goes for the market. Very, very simple. Okay, so let's say this is the, right, I'm just gonna make this right up on the spot. So let's say this is the price of toilet roll, okay? Let's make this white, there we go. So this is the price of toilet roll right now, currently, okay? Let's just say it's a supermarket, and this is £3 or dollars for you American guys. So £3 is up here, and then down here we've got 1, right? So this is really annoying. So we're fluctuating between £3 and £1. You're gonna wanna wait to buy toilet roll when it's at £1, right? So down here you're buying, and then up here you're selling. Obviously this is in a bearish market, so the better idea would be to look at this chart. So this would be £3. This would be 1, so you buy when it's low, and then you obviously, if you don't sell toilet roll, do you know what I mean? But if you were to sell toilet roll, you'd sell it at a premium to people to make a profit. There we go. Very, very simple. So you see this swing here and this swing here. I mark those out, and this is my range for premium discount. This being premium and this being discount. Let's move on to the next slide. Now, how to plot it. When plotting the premium discount, you can either use your fib or the Gann box tool, which I'll show you guys in a second. You want to draw it from the most obvious swing points on whatever time frame you're using. You don't really want to be using the lower time frames, and this is just because it's a little less like clear. You're gonna have tons of ranges, so it's not gonna be clear. You want to use the higher time frame price swing. That will give you a lot more conviction. So like here, let's say this is the hourly time frame. You draw that up. So you draw it from here to here, and then you'd have that half point, which we traded down to, rejected, and we trade down to, rejected, trade down to, rejected, and so on and so forth. So for a bullish trend, you draw from the low to the swing high. And for a bearish trend, you would do the opposite. Obviously, let's say this was going down, you would draw it from this to this. Let's move on to the chart, and I'm gonna show you an example of how this works. Okay, so when you're on the chart, you will find in the top left, 3 down Fibonacci. Now, if you hold that down, you will come down to Gann box. Now this is the one I use because I use the Fibonacci for other things, but you want to click Gann box and you want to just click and then drag, okay? Mine looks like this, but yours will look something like, let me just reset it actually. I'll apply the default. So your Gann box will look something like this. Like you might think, what the hell am I looking at? This shit looks like, I don't even know, some like Einstein equation type shit. So let's make this look a little bit better. and have that 50% mark very clear. So what you want to do, turn off time levels, because time levels are the vertical lines. We don't need that. We need premium discount, which is that 50% there. And then what we want to do is turn off the in-betweens. So we've got 0, 1, and 0.5. That 0.5 is going to be your middle section. If you want to change anything like the background, you can do that here to make it lighter, or even have no background. I like to just have that. And then you can obviously change the colors here. These are the settings that I have. So just 5 in on the top level, and then same with the 0, and then the 0.5 on this side with the green. So this is obviously my premium, and this is my discount. Perfect. So now let's use this for an example. So here you can have, what do we see? Perfect example. We have this new week opening gap we want to see get filled. We have on the hourly chart, we've got strong displacement above a previous high. We've also changed character and formed a fair value gap, right? So boom, boom. This is our fair value gap. I'll mark this out now. There we go. So we've got that, and then what happens? Price. I'm hoping this is going to print 1 hour candles. No, I think it's going to print 15-minute candles. That's fine. We'll do 15-minute candles. I'll just spam it. So let's say we want to get an entry within here. We want to see this full. So we want to see price come all the way up to here, but we want to catch an entry. Now, we're not just going to buy this in the premium. So like if we draw this to here, boom, boom, what have we got? We've got this. This whole section here is our premium, but we want to be buying it in the discount or around that discount level. It's fine if it comes up to like here, just above. That's probably all right. Actually, it is all right. I know I said probably. But you ideally want to see, if you have not overly strong conviction, see that price come down to the 50%. So let's play this out. I believe price comes down at taps. There we go. So we're in here. Now we're looking in this hourly fair value gap to find entries. Now that we are in the discount, and what happens? We reject from this fair value gap, and then in the discount, and boom, we come up to fill this imbalance. Right, boys. So let's get started now on time. Very, very important. If you don't understand time within futures, you are going to fail big time and get slapped. We use ICT kill zones, which a kill zone is a time of day when a specific session is. These sessions are when there is most volatility in the market and leave a very nice liquidity pool for the other sessions to target. Asia session, this is all for EST, is 8 p.m. to midnight EST. And then London is 2 a.m. to 5 a.m. And then the New York session starts at 9:30 a.m. and finishes at 4 p.m. Now, there are 3 types of New York session. You want to avoid trading in Asia session, as it is the session out of the 3 with the least volatility. So this tends to be a consolidation. So obviously you don't want to trade that. There's not much volatility in the markets, and the market isn't really moving as such. London is usually okay to trade, but it still doesn't compare to New York. If you really want that high win rate or higher win rate or more conviction, you really want to be sticking to the New York, where the most volatility is in play. There are also only 2 times we want to be trading the New York session. Now, so they're split into 3, but there's only 2 we want to trade. Let's move into that. The New York session sections. The New York session has 3 sections: the AM session, lunch session, and PM session. Each time has different characteristics, but for the model, we will only focus on the AM session. Another thing to note is that if we have good PA in the AM session, it will likely be bad for lunch/PM, and if the AM session is bad, then lunch/PM can have good PA. I would also like to add that you want to avoid trading the lunch period full stop. So if AM has bad PA, then regardless, avoid it. Okay. So lunch is from 12 to 1:30, and AM session is from 9:30 to 12, but we are only trading 9:30 to 11 because PA is just different after 11. That's sort of like when it the phase into lunch, so you don't want to trade 11 to 12 either. So in actual fact, think of lunch as 11 a.m. to 1:30. Also, another thing to note is that news is mainly like the main red folder news is released at 8:30 a.m. Eastern time. Now, we'll go over news in a couple of seconds in the next slides, but a news candle will look something like this, and this is a very strong draw, and it's released at 8:30, okay? Now there are other news releases at, let's say, 9:45 and 10 a.m, but the main ones are going to be released at 8:30. So our next section is going to be about news. NFP, 8:30. See what I said? Boom. Let's go. So, what is news and how does it affect the market? My dog has decided she doesn't want to be in my room. So, bear with me. Actually, wait. Come here. Okay, let's go. News release can be anything from NFP to interest rate data release. These are economic news factors that will ultimately have a huge impact on the markets. When is news released? Most of the time, news is released at 8:30 EST, but sometimes it can differ. I recommend using a website called Forex Factory. This will be able to filter red folder news and tell you when news is releasing for that week. You want to know when news is releasing because you don't want to get chopped up. Now you also want to avoid trading when there is news about to be released. So you want to avoid trading right before the news or holding a trade into the news, as it's unpredictable and some props will actually get funny about you trading around news. So some prop firms can actually cancel your accounts or instantly fail you if you are holding your trade through a news release. Just a little side note as well, you can also use news, high impact news, to pass evaluations. So, direction. News can also give us an insight into the direction of the market, and here's how. Let's say you have a weekly target and you want to see it hit. A catalyst for that move to hit that target, whether it's equal highs or lows or an end dog from the previous week, the news release will most likely aid in the push to that level if correct. As you can see, just like in the liquidity section of the course, the wick left from the news release acted as a magnet. FOMC. FOMC is a type of news which is released in the PM session around 2 p.m. Now you want to avoid trading the AM session if there is FOMC, as this is what price action usually looks like. Don't want to trade this, very highly consolidating, and it's just not fun to trade. So FOMC, short for Federal Open Market Committee. I'll let you do the research as to what they do. All you have to know about this news event is that it makes speculators uncertain, meaning choppy price action and no real direction until the news has released. This news event can also affect the day before, so I would even be wary of trading the day before FOMC as well. So now I'm going to show you on Forex Factory how to actually set up and look at the news that you want to be looking at. Now, you have grey, orange, and red folder news, and red folder news is the one you want to pay attention to. So let's go have a look. So when you open forexfactory.com, you want to come over to calendar. Once you click that, it will come up with this. Now, mine is already filtered. Let me just put these back on. There we are. So this is what it will look like. And you're going to be like, what the hell am I looking at? So we want to filter out all the yellow and orange. Also, there are actually 4 types of folders. That's yellow, orange, and red. And obviously red we want to pay attention to, okay? So, and grey I believe is a bank holiday. So we want to go up to the top right where it says filter, and we want to click that. And then you want to unselect all of these or deselect all of these. And you also want to go to currencies and you want to uncheck everything apart from US dollar. Okay, so the only thing that we care about is the US dollar. Okay, so apply filter, and you can see today on Monday, the 2nd of February, we had ISM manufacturing at 3 p.m. my time. This is 10 a.m. EST. So I can change the time here. New York Eastern time. Save settings. Boom. So at 10 a.m. we had news release, and then Tuesday, tentative. Tentative means they're actually not sure if they're going to release it. And then on Wednesday we have at 8:15 we have non-farm employment change, and then ISM at 10 as well. And then 8:30 we have unemployment claims, which is a big one. So you can see here we filtered all of these folders out to now see this week with just the red folders. So that is pretty much that when it comes to news and all you need to know. So just remember, one key takeaway is definitely that you do not want to be trading before FOMC. So the AM session before FOMC. I would just avoid that. It's just choppy, unpredictable, and you just don't really want to trade that in general. So yeah, moving on. Okay, and for this part of the course, you're going to need the double chart, which I told you about earlier. So this is SMT, which stands for Smart Money Technique. So let's go through what this actually means. So what is an SMT? An SMT is a break in the correlation between two correlating assets. This can be seen when one index takes a high that the other does not. This indicates that smart money is present and the index that did take the high in this instance would be stronger than the index that failed to take the high. So let's say we have NQ and ES, two correlating assets, they move simultaneously together. When they do not and they break that correlation, this is an SMT. So as you can see here, NQ failed to take the high, forming a bearish SMT. This will indicate that price could move down and that NQ is the weaker of the two indices. By the way, if you have a bearish SMT, it's on top, and if you have a bullish SMT, it's on the bottom. An SMT will not 100% guarantee that you are going to go down. So a lot of people make that mistake. So you want to make sure that when you do get an SMT, it makes sense. So it's like in a position that will make sense, and I will show you what that means. And as you can see here, ES took the high, forming a liquidity sweep, and also indicating that ES is the stronger of the two at this moment in time. Okay. So rules with SMT. Also, wait, quickly, if we were going to short here from this SMT and reaction, then the best pair to short with would be NQ, obviously, but we only trade NQ, but that's just the theory behind it. You want to short the weaker pair, right? Now, rules with SMTs. You only want to trust an SMT when it forms in a place that you expect it to form. Well, not only this, but you want to avoid false SMTs, which can be a lot more common if you're just focusing on the lower time frame SMTs. As well as the lower time frames faking you out, you need to be very careful when using SMTs that form inside chop, as they are always less reliable. This is an SMT within chop, and this can be formed with like a consolidation, so there's no real market direction, and this can just be literally an accidental SMT. So that shit just does happen. So that's why I've got to be careful of taking SMTs that occur within chop. They need to make sense. Maybe it's a manipulation, maybe these two. That makes a bit more sense because price manipulated below this low, and then we moved up. So this will make good sense, and we looks like we entered for value gap here. If this was a higher time frame for value gap, it'd probably be better, it'd be stronger, you know, whatever. So an expected SMT. The 4 hour, we have a 4 hour for value gap here, and we get an SMT within that. Now this is a very, very high confidence that the SMT is going to hold. So if you do get an SMT within a high time frame for value gap, this is a much stronger probability than just having a random SMT. Lower time frame, meaningless SMTs. So look at this volume. We haven't really got much volume. Nothing was really taken. We're sort of inside of this leg, and it's just a random SMT that we really don't want to be taking. Let's have a look at some chart examples, and I want to go through a couple of other things. So the first thing I wanted to set up with you guys is how to actually get the double chart on your chart. And what you want to do is you want to come over to the top right, and you see you have this, okay, layout setup. Click that, and then you want to click the 2. Boom. So now you have the split, okay? Now you want to have on this, you see if I click this, we have ES1. This is ES, obviously. And right now I currently have MNQ on here. So MNQ, NQ, they move very, very similar. So you don't have to worry about having that opposing, but you do want to do your analysis on NQ instead of MNQ if you are trading the Nasdaq. So for example, right now we literally have an SMT as we speak. Here, price hasn't taken this high on NQ. We have taken it on ES. Now I have a template for SMT. There we go. So I can make mine easy to spot. There we go, SMT. So now this could indicate a bearish move. We're also inside of bearish 4 hour gap, so this could also indicate a bearish move. We also have a big imbalance here, so would this bearish SMT make sense? Yes, in my opinion this would make sense. So we'll see how that plays out today. What we're going to do is I'm going to pause the video and I'm going to ask you where you can see an SMT. Pause the video here and see if you can spot the SMT, and I will show you exactly where it is. Well, the main one I'm looking at right now. Pause the video, bro. Okay, there you go. Right. So now you have decided where you think that might be. I'm going to mark out for you. So here you can see we have the SMT. Okay. Oh, wumped. Let's change that to SMT. And then we also have it here with this high. Okay. So this is your SMT, and as you can see, this acted really, really well. We came down and then swept this sell side here straight after getting that SMT. So that is everything you need to know about SMT, guys. Let me know if you would like any extras on that, or if you'd like a whole video dedicated, and let's move on to the next section. Also, if you've got this far, comment trade. Okay, comment trade, and I will know that you have stuck this out, and fair play to you, because by the end of this you'll be taking some damn good setups, my bro. Moving on to AMD. Now, AMD is accumulation and manipulation and distribution. And a lot of people struggle to understand this concept, but actually it's very, very simple. There's 3 steps to an accumulation, manipulation, distribution. First, we have the accumulation phase, which is this phase here. Then we have the manipulation, which is this here. And I'm going to make this red. And then we have the distribution, which is here, purple. There we go. So we have accumulation, manipulation, and your distribution. So what does this mean? When the market accumulates, we are building up orders, and then we are manipulating, which is stopping these people out within this. And then the market continues in its original direction, which you'll focus on your draw on liquidity here. So let's put this as this, I believe. Yeah. So your draw on liquidity is up here. You have accumulation, manipulation, and you distribute to the liquidity. Okay, and it's the same with the bearish example. So you have the accumulation phase here, the manipulation phase here. So you manipulate up, and then you have that distribution afterwards. This actually happens on all time frames. So like ranging from the 1 minute to the 5 minute to the 15 minute to even higher time frame 4-hour AMDs, maybe even daily. Obviously, if you're on a daily time frame, these AMDs are going to take longer and longer to play it out, which is actually better for you in terms of having that nice bias for like a long time. So you can use it to your bias as well. But for this example, we are going to come down and I'm going to show you a couple of examples here. We can see we are bullish. Price then accumulates, we then manipulate, and then we distribute. So we have that accumulation phase, manipulation, which happened around 9:30, keep that in mind, so the open, and then we move up to distribute, okay? So we have a high time frame liquidity draw up here. We manipulate down into the 1 hour fair value gap. Let's put it 4 hours as well, into a 4-hour fair value gap as well. And we then get a 5 minute, like I say, inversion to the upside. Okay, so we get that accumulation, manipulation, IFVG, inverse fair value gap, and distribution. So go into your charts, do some back testing, see if you can find those accumulations, manipulations, and distributions. Let's head down to the 1 minute chart just to show you that you can actually see all of this going on the lower time frames. You can see price on the 1 minute chart. We actually accumulate here, then we manipulate, and then we distribute, okay? And that again, you could have caught a very nice IFVG trade within that. Okay, so using that framework, the market sort of moves within that and around that framework on the lower time frames, higher time frames, etc. Okay, so here as well, you can see accumulation, manipulation, distribution, accumulation, manipulation, distribution, accumulation, manipulation, and your distribution leg. I hope that has cleared AMD up for you guys. Let's move on to the next section. This part of the video is going to be about daily bias, but I'm also going to tie it into another concept, which is conditions, okay? So, daily bias. There we go. Why do we need a daily bias to begin with? So daily bias is formed before the market open and essentially gives you a better understanding of where you think the market will be headed that day. This can be formed using multiple confluences to really build a narrative on why you believe the market will move the way it will that day. Another really important thing to note is that you cannot get married to your bias. What I mean by this is that if you get married to your bias and your bias is wrong and the market is clearly showing you that, yet you still try and trade in the opposite direction, you will pay the consequence. So if you are set on a bias, but the market clearly shows you you're wrong, let's say we get heavy displacement away from your ideal target for the day, that is a sign to say, okay, well, maybe I might be wrong. So reassess, because if you just stick to your bias and you carry on taking positions towards your original bias point, you're going to take a load of losses. The first component is 1 hour and 4 hour fair value gaps. Looking on the hourly chart, you can see that these fair value gaps got closed. Once closed, you can expect price to take the inversion direction high or low. Okay, so what does this mean? So we get an inversion, and then we use that like the lower time frame model on the higher time frames as your bias. You also want to find your most obvious draw. The most obvious draw can be identified as anything from higher time frame, relatively equal highs or lows, to an old data wick. So essentially the most obvious draw is a liquidity pool that is most likely to be hit that day. 15-minute relatively equal highs is a perfect draw. And then we have the most obvious draw again on the right hand side, which is just under the most obvious draw that we got from the previous week. Now 15-minute LR has a high probability to get hit. Paired with the relatively equal highs, this is a very high probability. So going into this day, you would be looking to target these highs. Turns out these were actually 4-hour relatively equal. Okay, so 4-hour relatively equal high is a perfect draw. Then down here we have, with the most obvious draws in place, now you can see it that we get our higher time frame inversions, which ultimately lead us to the target we had in mind. So first of all, we have this fair value gap here, this very large one. And we also have these here. So paying attention to these, this one gets inversed, and we also inverse this higher time frame one here, or like this larger one here. Sorry, not a higher time frame. So if we move over here, you can see this has not taken this obvious draw yet, but we have inversed this fair value gap, meaning that it's failed to continue the market down. So we're looking for bullish price action to then target this draw. So it's basically tipping its hand to say, yeah, okay, we are ready to go bullish now. Looking here, we see this 4-hour as well has inversed, and we are coming towards this first liquidity pool. You see this 4-hour here gets inversed, and then we look to take our model entry or our trade entry from wherever we are after the inversion to these targets. Okay, so you're targeting, you are finding that narrative of where you want to see the market go to. Now, something that I did miss in these slides is the fact that the market actually does seek inefficiencies or seek to rebalance the market, and it also seeks liquidity. So you can see here, if I was going to look for a daily bias, let's just go to a random point. Let's use this example as we've done it a few times before. So we have our draw, okay? This is what we want to see get closed, and we also have swept sell side liquidity. Okay, we have rebalanced the market. Now, what are we looking to do? We're looking to rebalance this inefficiency, so this gap in the market. Okay, so inefficiencies are essentially gaps as well. Same thing, it's just a different word of saying it. So we are looking for price to target this. So we are, with our daily bias now, we would take a picture of this, and then what we would say is, okay, I can see that we have a nice market structure shift here, a large 1-hour fair value gap, and a good target. We've also swept sell side liquidity. So now what we're looking for, we are looking to get long somewhere to fill this gap. So we have a bullish daily bias. I guess the main things you need to be looking at is, are we rebalancing efficiencies? Is there anything below we could be targeting? If not, then you're most likely good to go. So if you have no liquidity pools below, no fair value gaps to rebalance, you have a lot of buy side liquidity left to target, that will be a bullish daily bias. So I actually did used to drop my daily biases into a Discord, so let me go over a couple of those for you now. So as you can see here, I say, good morning guys, today I'm pretty bearish given the reaction from the 50%. This may change with potential inversions, so the 50% being the rebalance of the leg. This will change with potential inversions occurring before the AM open. My reason for this is due to the 1-hour inversion marked to the left, yet it did not close on the 4-hour, so still cautious of that. If we do turn bullish though through the day, I would love to see the previous day high taken and a reaction from the 4-hour fair value gap. Respecting this 4-hour fair value gap, and we came into the 0.5, so the half point of this range. We also had an SMT with this 4-hour fair value gap, and what else did we have? We have an inverse of the 1-hour fair value gap, okay? So I was looking to target the previous day low / Asian low, which is the Asian session low. And this was the IFVG on the 1-hour target, okay? So this is how I form my daily bias. Now is where we come into conditions, okay? So this 1 hour was my condition. If this 1 hour closed at 10 and we did not take these yet, then I would be bearish, very strongly bearish. But if it held, then I would potentially look to, or even just fade any trades that day, just because the bias was unclear. So that 1 hour inversion, if it did close at 10, would show me that we are respecting bearish price action and disrespecting bullish price action, meaning it's just a bit of a confirmation or a tip of the hand to say we are bearish, okay? So that is how I found my daily bias for this day. I hope that makes sense. Now let's go into some more conditions with you guys. Okay, so now let's move on to conditions. Now you saw a good example of the condition and the 1 hour fair value gap in the previous example, but the 15 and 5 minute are the main conditions you're going to use. So these are basically confirmations to your liquidity. So let's say you have a draw of liquidity above. So here is your draw of liquidity. Okay, let's just mark this DOL. So this is your draw of liquidity, and you want to have that confirmation that you are bullish and that your drawn liquidity is correct. So how do we get that? So here you can see price respected this 15-minute fair value gap, and we inversed this 5-minute. So this is a tip of the hand to say, okay, we're respecting bullish and disrespecting bearish, and then we respect this 15. So after you get this disrespect, you could obviously take that 5-minute straight up to here and look to target it straight after we inverse this 5-minute. But here you can see we have a 15-minute that we actually respect, and you could look to get an entry after we tap into this. So if this holds, then it is a guarantee, or not guarantee, nothing's guaranteed, but it's a very, very high probability that this draw on liquidity is correct and we're going to deliver there. So you are looking to take longs, maybe if we have a 1-minute fair value gap in this leg, to take longs to target that draw on liquidity, or even from here you could just target that from there. Okay, so that's a bit more on conditions. So it's just really a confirmation on whether your drawn liquidity is correct and your bias is correct. Okay, so if a 15-minute is holding, then let's say, for example, down here, I'm on the 15-minute chart already. So you can see here, this 15-minute held, and we disrespected this 15-minute. So there we go. Now we're bearish, and now we literally just dump all the way through here. And it's no surprise because we have all this liquidity built up already. That's a good example. Good. And then we inverse these 15 minutes, and then what do? We form another 15-minute and we respect it. So that would be, okay, we're respecting this one, and we've closed here. So let's look to get some longs. I'm sure we could have found a long within this price action here. And then let's go for another example. Here you can see we disrespect this 15-minute fair value gap here, and we come down to take this low. 15-minute gets inversed. Boom, 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 boom. Take the low. Boom. So let's say I have let's say going into this day, right? Okay, we'll play a bar, and we'll play it from the 9:30 open. Okay, so let's say from this day, if we inverse this, so we swept this buy side, and I'm looking to take this, let's say, for example, right? So this is London session low. So let's say we're just going to target London session low. I want to see this 15-minute gap get disrespected if we are going to target that low. Okay, so then we can play price out. Oh shit, and we do displace heavily below that. So that's obviously not a great example, but you can see here the 5-minute we displaced. Sadly, price just dumps through this. But that was just an example of how I would look for it. So we respect this 15, we disrespect this 15. And then you can see how we might react to this 15-minute. So like, let's say we could be looking for shorts in this 15-minute. Or we could be looking for longs, depending on, here we go. So like, for example, we have swept buy side now, and we've inversed this fair value gap here. So we could be looking to target either this fair value gap now, or even this low. But you can see here, we open here as well, and we come up, we sweep liquidity, we then can see that we come down, disrespect this fair value gap, we go bearish, take this liquidity then, and then we are respecting these 15-minute fair value gaps. Now that might be a lot to take in, I've just rambled a little bit, I do apologize, but we're respecting these bullish fair value gaps, so we are expecting price to blast through this one here, so the 15-minute here. Now if this 15-minute fails, then what? We just blast through it, which is not ideal. But the 5-minute, you can see the 5-minute closed. That gave us our confirmation. If you are on higher volatility, you could just go to the higher time frames. That can also help just to get those entries before it does blast straight through like that. So sometimes you want to use the 5-minute conditions, especially if there isn't a 15, you want to use the 5, or if you're doing lower time frame conditions, etc. Okay. So that's how you can confirm your bias with conditions. Okay, boys, now we are onto the juicy stuff. Now we are moving on to the models. There are 2 types of models, but first let's understand what we need to do to build our trade idea and what we want to see happen in the market, okay? Ignore this arrow here. We're going to go over that in a minute. But first we want to build context, okay? So firstly, we are trading from 9:30 to 11 a.m. EST. That's just very bog standard. That's New York AM session. That is just all you need to know about that. And you want to have a strong, confident draw on liquidity. Okay. Now this could either be liquidity, like a liquidity point, or even a higher time frame fair value gap. Okay. And then you also want to be reacting from a higher time frame key level. So what I mean by this is, if we come into the morning, let's say we remove this. If we come into the morning and we look to take a trade within this leg here, we've already reacted from the 1 hour. So we're looking to get a continuation from that. So let's move on to executions. Now, you want to enter on the highest time frame in the leg. So 1 minute, 2 minute, 3 minute, 4 minute, and the 5 minute time frame. That is the highest as well. And when I say highest time frame in the leg, what do I mean by this? So here you can see we have this 1 and 2 fair value gaps. But if we went on to the 2 minute or okay, I'm on the 15 minute time frame, but for this example, let's say this was the 1 minute, and then we go to the 2 minute chart and there's only one. That is, so you'd want to be taking it on the 2 minute. Or if there's higher singular fair value gaps, you want to enter on those. So they have to be singular. Go to the highest time frame with that fair value gap, but make sure it is singular. That is the most important thing, because the biggest mistake people make is they will be, let's say, taking a long, and they take this and they get fricked because they took an inversion like here. Let's say, oh, wrong one. They took an inversion here when actually there was another gap here which we just traded into. Okay, so they're taking this long from this inverse fair value gap when there's another one above. So you want to make that singular, and when you make it singular, you'll probably find that there's a 5 minute, let's say, and it will look something like that. So you want to ignore the duplicate time frame, duplicate fair value gap legs, and you want to focus on the singular legs. Okay, singular fair value gaps in the legs. Okay, so you need to think, are we delivering from a key level? The sun's just gone down, so I apologize if my camera looks weird now. So you need to think, are we delivering from a key level? So this is, again, the context. Key level, 1 hour fair value gap here, perfect. 4 hour. But when I say key level, higher time frame key level, what I mean by that is higher time frame fair value gaps, okay? Or even draws on liquidity. Something like a session high maybe, paired with a key level, paired with a 1 hour fair value gap, or a 4 hour, or even a daily. So it's those higher time frame fair value gaps which are your key levels. And then we need to think, have we manipulated? Now the manipulation is obviously the sweep of liquidity, right? So that is all you need to know on that. And then here are the two types of model. We have the KT reversal model, Kieran Trader reversal model. And what you're looking for here is a manipulation, an IFVG, and a draw on liquidity or target, okay? And we'll go over that in just a second. And then the next one is a KT continuation model, which is projecting from a higher time frame PD array. And then we have an IFVG and a continuation to the target. And when I say IFVG with these, just remember, make sure they are singular. Another thing I wanted to go over was to target the low hanging fruit, okay? Now, what I mean by this is you might have a very strong draw on liquidity for the day, but you really don't want to be getting those unnecessary break evens. So as soon as you get that high taken, you would obviously go break even, and you might see something happen like we come up, hit your break even, and then hit this TP, and then we go straight to a break even and you're out of the trade, okay? Don't want to be doing that. So what do you want to do? You want to target the low hanging fruit, which we might have a higher draw, but we're actually going to target that internal high and just take our piece of the pie and be like, okay, that's it. That's I'm happy with that. I'm done with that. And then you walk away with profits and happy days. If you wanted to hold a runner, you can take partials at this 1-to-1 and then let this run. But most of the time what you'll find happens is we might get this retracement and we literally come down, tap the break even, and then go straight to your TP. So just while you're starting, target those 1-to-1s, low RRs, and you should be good to go. But let's actually get into the models. We have our accumulation, then we have a manipulation into a higher time frame key level. Now this could be anything from the 15 minute, 30 minute, 1 hour, 4 hour daily fair value gap, okay? There we go, that's simple. And we get that singular fair value gap in the leg that manipulated. So you want to also only be taking inversions from the manipulation leg. So let's say you have, let's say, an inversion here, right? Price comes down and we inverse here. You don't want to be taking like a fair value gap from here because it's just old news, okay? You want to be sticking to the most recent manipulation leg and the singular fair value gap within that, okay? So we get that accumulation, manipulation into a higher time frame key level, and then we get that inverse fair value gap. Now, with your stop loss, you want to put the stop at the high, okay? I'll go over that in a second. And then you want to target your draw of liquidity, obviously taking partials maybe here, and then continuing down. Now, the continuation model is a bit different. So here you see, let's say, pre-New York session, we came down and we manipulated this low, and then we reacted from a key level already, okay? So we're not trading in this time, and then what do we have? This leg printed a 15-minute fair value gap. Now this 15-minute fair value gap would actually be sponsored by the higher time frame key level, and what this basically means is because it came from this higher time frame key level, it has a lot more probability to actually hold and continue the move, okay? So we get then an IFVG off this 15-minute fair value gap with a continuation from the higher time frame key level, and then that is your continuation trade towards your drawn liquidity. Now, if you have a drawn liquidity down here, you're most likely going to get confused. You think, oh my god, like, bro, we have drawn liquidity down here, but reacting from this high time frame key level, maybe your drawn liquidity is just wrong. Okay, so maybe you just need to assess if the market is moving away from you. Okay. And that is that for the two models. I'm going to go over some examples in a second. Do not worry. Okay, I can hear you through the screen, literally going, oh, but what, I need to see live examples. And don't worry, brother. Okay, we're going to get to that. Okay, now stop placement. If you get an IFVG, all right, and you get your entry, you want to put your stop at the high. Now there are certain rules you can do, like if you get an SMT, you have to use the high, or if there's like a breaker block, you can just put it here. But for this example, you just want to go at the high. Now, it's just the easiest and like just most obvious place to put it. You're going to be safer, your win rate is going to be higher. So if I were you, just put your stop at the high, okay? The manipulation high. So let's say we came down, we manipulated these highs, and we get your reversion from a key level up here. Let's say we have this high time frame key level, and then you want to put your stop at the high that manipulated. That is pretty much everything. Let's go into some live examples. We're going to do a bit of both. So I'm going to show you a reversal model and a continuation model. Okay, so for this example, guys, let's see what we've got here. So coming into this day, what was I seeing? We have these relatively equal highs already printed. Now, we can put those as relatively equal. So we have our draw on liquidity already set. Now, what do we have that can maybe take us to that draw on liquidity? Here we have a 4-hour fair value gap, okay? So this is our higher time frame key level. So now we go down to the hourly. We have the hourly on here as well. And let's go to the 15. Okay, so now what do we have on the 15-minute? We have relatively or actually equal lows. So we have equal 15 minutes, okay? So we've got equal 15 minutes below us. And we also have that stronger draw above, right? So what are we looking to see? If we want to see that manipulation, IFVG, and the continuation to the draw and liquidity, we want to see these get taken, react from this 4-hour fair value gap, and then get an IFVG to target these, okay? So then what? We go on to the 5-minute. Time is 5 AM here. Let me skip this up a bit. So as you can see here, now these are even more relatively equal. And what have we built up here? We have built up liquidity. So there are 3 stacked and also 3 15-minute equal highs, okay? Very, very strong draw, and we have a 15-minute fair value gap up here. So like this is a perfect draw on liquidity. So we'll put those down as equal 15 minutes, okay? So my idea here is we either take this, and then what happens is we get an inversion to the downside to target these, or we come down first and then get an inversion to target the upside, okay? So let's see what happens. So if you're looking at the 5-minute, well, actually let's go down to 1 minute. Okay, so what happens? We open up, there we go. We open up, we trade higher, and then we trade lower. We get this inversion here, but we take the high before we can actually enter. So this is a no trade, okay? Then we re-sweep, so we get another manipulation within this fair value gap. Beautiful. And we are currently keeping in mind that we are inside the 4-hour, and then looks like we've got loads of fair value gaps in this leg. So what are we looking to do? We're looking to take those into a singular fair value gap, okay? So we'll go up to 4-minute. Is there a 4-minute? There is a 4-minute. Is there also a 5-minute? Yes, there is, okay? So we take the 5-minute, we mark this out, 5-minute fair value gap. So we want to see this inverse if we wanted to take longs. So now what have we done? We've accumulated, we have manipulated into a higher time frame key level, and now we're looking to get that inversion up to the draw on liquidity, which is up here. So then we wait for that IFVG, which we get. I see we close here. So what did I do? I entered my long position here with my stop. I put it at the body close, but you guys put it at the low. And then I was targeting my relatively equal highs drawn liquidity for a lovely, easy 1-to-1. Okay, so we play this out and we get this first candle, boom, we go break even here and we leave this running for that 1-to-1. Obviously you would target low hanging fruit if you had a smaller RR, let's say like this, but in this case we do not, so we've got to wait for that full close on the 1-to-1. So we get this up here, which looks very, very nice, very, very promising. We've also closed this with displacement, just to add. So this IFVG here, you can see we've closed way past the fair value gap, so we've got a nice displacement on that, a nice strong candle, and then what happens next? We blast straight through the take profit. We've taken liquidity, we've respected a 4-hour fair value gap, which is our higher time frame key level, and then we have ran straight to our relatively equal highs, which is our drawn liquidity. Okay, so that is your KT reversal model. Okay, now let's go and see if we can find a KT continuation. Okay, so coming into this day, let's see if we can spot our draw on liquidity that we want to see get hit. Now, the draw on liquidity I want to see get hit is this beautiful new week opening gap. Okay, and now what do we have just below that new week opening gap? We also have loads of stacked highs. So this is our very strong liquidity draw. So stacked highs, so we've got relatively equal highs here and a new week opening gap. So this is a lovely target, but we've already displaced after taking these lows. Okay, now also where are we actually displacing from? A 4-hour fair value gap. Okay, we have reacted already from a higher time frame key level, so 4-hour fair value gap, and we are looking to target these up here. So we have higher targets and we've got a bullish bias. Yeah, we've already reacted from a 4-hour fair value gap. Okay, so now what are we looking for? We are looking to catch an entry. Let's see, what do we have? On the 15-minute, we open up and let's play price out. We have this 5 minutes here, no, 15-minute here. So a higher time frame key level on which is the 15. And what do we also have done here? We also have an SMT. Given this 15-minute fair value gap, we are looking to react from this fair value gap. Like I said in our example earlier, we are looking to catch a continuation towards our draw of liquidities. So we've respected a high time frame key level, we've printed another 15-minute key level, and then we're looking for price to react from that key level and sweep this intermediate term low, which is a low inside of a fair value gap, or at a fair value gap, to actually react and then target those highs. Okay, so let's go and play this through. So what happens? We come down into that 15-minute fair value gap. We also take this liquidity here. Then price moves down again. We get an inversion here, which I don't think I actually took. I wanted to wait for a higher time frame. So if you go to the 2-minute, you can see we're already basically at this 2-minute fair value gap, or the 3-minute is here, and if you go to the 4-minute, we then have a 4-minute here which closed nicely. Okay, so I entered off this 4-minute with my stop actually here, but for you guys here obviously, so I'm going to put my stop here, and then I targeted these highs as well as an unfilled, I believe, 15-minute gap, or was it an hourly? I believe it was this hourly gap I targeted first, and then I let it run to the relatively equal highs. So let's play this out. So we've got, there we go, that closure. So look, what do we have? We have this SMT here now, okay, which is added onto our position. So we've now got an SMT against this. We're inside of a 15-minute, so we want to see that SMT inside of that 15-minute is ideal place to see it. And now we've got an inverse fair value gap with clear targets, an hourly fair value gap above. I don't know what that is. So a higher time frame key level target as well. And yeah, we just want to see this play out and take our profits where we can. So we would have gone break even at this high. There we go, break even. and then price runs up. We get that first TP, which was a 1-to-1, I believe, around there. And then we continue to hold this. I believe I held, I think it was just like 2 micros to the relatively equal highs. So overall, really nice continuation trade. KT, continuation model, yeah. So yeah, that's pretty much that. That is everything to do with the models. If you have any questions, do let me know. I hope that makes it a bit more obvious. And obviously this trade I took was within that that I showed you with the price action before. So you can see we come up, and then let me change this to, oh, I can't. We basically come down to that EQ of the range and then fill this fair value gap, and then we continue up after having that market structure shift. So you probably could have gotten more longs after that as well, given the fact we were in a higher time frame key level here as well. So yeah, that is pretty much everything with in terms of the models. Now let's go over some stuff about routine, or what your life should look like off the charts in order to have that mindset to make good profits within the market. So now we are nearing the end of the course. Now I hope you guys enjoy so far, but now we're going to build your trading plan, okay? So this is the execution now. Now we've learned all this, now we're going to apply this, okay? So first of all, what you want to do is you want to start with paper trading an account and trade that account until you can pass a funded. So what that is a 50K funded. Let's say you were trying to pass one. So you would do 3K profit target and a 2K max loss. If you lose 2K before you hit 3K, then you didn't pass the funded and you have to restart, okay? And you want to risk 0.5 to 1% a day and only take one trade a day, okay? That is the first step. Once you've done this and once you have passed that account, you want to look at buying your first funded, okay? I'd recommend Alpha Futures, Traderfy, or Luna. Luna's quite a new one, so maybe be a bit careful of that one, but Alpha Futures and Traderfy are usually very beginner friendly and they don't have that strict rules, so I would go with those two. And Luna, obviously, Luna Flex account's really good for beginners, and yeah, they're just a really good up and coming prop at the moment. I don't have affiliates with any of these, by the way. I literally am just giving you straight advice here, with no bias at all. So trade the account the same as you did on paper trading. It will be harder as now your emotions are involved. So when you find that you go into the live markets now, it's going to be a lot harder than just doing it on paper, because now your emotions are in play. You get close to passing the account and you're going to be like, holy shit, I'm about to pass my account. This trade can pass me my account. Let's take it. And then it fails because actually it wasn't actually that great of a trade, but you wanted to just pass your account. So that's pretty much how that can affect your mentality as well. So just take that and keep that in mind, and this second step will help you a lot when it comes to growing emotionally as a trader. Third of all, and the last phase of your trading plan, is once you've passed your account and traded it to eligibility for a payout, you can request a payout. So once you have got that first payout, you are not going to buy a fancy watch, because I know that's what you would do, but instead reinvest it into more accounts. And once you have these accounts, you can build and build them until you have, let's say, 5 accounts, all trading, all copy trading the same trades. This will allow you to make 5 times the amounts you are making with just that original account, okay? So all in all, first of all, you want to paper trade and know that you can pass the funded, okay? So this gets you past that barrier of, I can't do it. Well, actually, you've proved to yourself you can do it, okay? So this gives you that confidence. And then once you've done this, you also learn risk as well at the same time, which is amazing without losing any money. And then once you've got that confidence and that reassurance that you can actually pass an account, you've got the proof, right? Then you can buy your account, then you can get a payout, and then you can scale it, okay? Then once you've scaled that, you'll come to realize that there are other prop firms like Apex, for example, where you can actually get 20 accounts. Now that's obviously, they have a lot more rules and it's a lot stricter, a lot less beginner friendly, but they are a good prop firm in general for especially scaling your trading. So yeah, that is pretty much everything with your trading plan. And now let's move on to your schedule. Okay guys, so now let's focus on building a good routine off the charts. So how can we build a good routine? First of all, we're going to start with when you wake up, okay? So let's go wake up. Let's make that a bit smaller. There we go. Wake up. First thing you could do is, before you even do anything, is go for a walk, okay? get up and make sure you are awake and put that discipline in early. Maybe even go to the gym, okay? Wake up, go to the gym or go for a walk. Just to get up, get yourself awake and disciplined before you even start. But before all of this, the main thing you want to do is this. Make your bed, okay? You want to make your bed first thing in the morning, straight away, just to anchor that discipline in straight away, okay? Let me just get rid of that, there we go. So first things first, make your bed. Wake up, make your bed, go for a walk, go to the gym, get ready for the day, you know? Prepare yourself for the day. And for me, I trade from the UK. So the New York session for me is at 2:30 p.m. But I'm going to do this just EST and just generalize for you guys. So wake up and we do all this shit, okay? Now, once we've done this, the next thing to do is to do your analysis, okay? Pause. So then we go to doing our analysis. You want to do your analysis at what time? 9 o'clock, okay? 09 a.m. EST. Okay? So 9 a.m. EST, you want to do your analysis. Another thing to add, which you could do when you wake up, is to journal. Journal how you feel and your general idea, what you need to do for the day. This just clears your mind in general and will help you to navigate the day ahead. Now, another interesting one, which not many people talk about, is back testing, okay? Now, this will not be really daily, but in terms of back testing, pause, back testing, there we go. So in terms of like weekly routine, this is something you should probably get done, and that is, in my opinion, 4 hours of back testing a week, okay? So 4 hours of back testing a week. This just helps you, even if it's just back test a week at a time. So every day, you just back test a week to keep you fresh. Let's say you don't take a trade for that week, that keeps you fresh. And you're also learning things while you're back testing as well. So very, very important. Now, the next one is you want to have a life outside of trading, okay? So you want to have a life outside of trading. Now, what does this mean? This means you cannot just focus on trading day in, day out, wake up on the charts for the whole day. That can't happen. And if you do take a loss and you just have your one trade a day, then you're going to be thinking about it all day if you just focus on trading. So this, you could literally do anything. For example, I go to the gym, right? And some people wouldn't even call that a hobby, but it's my life outside the gym, outside trading. So I go to the gym. I also play tennis, and I also run, okay? So I enjoy going to the gym, playing tennis and running, and just spending time with my friends in general. That's my life outside of trading. So I'm not focusing on trading. If I have a bad day, I'm trading, or let's say I crash out, let's say I lose 2 trades in a day and it's stupid and I broke my rules. I go to the gym and I have a hard ass session and that fixes me up. I'm not focusing on that outcome of that loss, right? So having a life outside of trading is very, very important. If you do focus just your solely life on trading, then you are going to literally probably destroy your mental. So yeah, definitely very, very important. Now, another good one is eating good, okay? So you don't want to be eating shit. You want to build discipline, all right? So let's just put this down as discipline, and I'll go into greater detail on each point. So discipline. Discipline off the charts is way more important than discipline on the charts, because your discipline off the charts translates straight to your trading. Discipline off the charts could literally be gym. This could be the gym as well. Like, the gym is actually such a big staple when it comes to trading. You can build discipline in the gym. You could build discipline when you're running. You don't want to go for a run, that's when you go for a run. That builds discipline, okay? Discipline, gym, run. Eat healthy. If you're eating healthy, your brain's going to be healthy, right? So what we're doing, we're eating healthy, we're running, going to the gym. These are things that will put your mindset in check and help you to gain that profitable mindset. Waking up on time, You want to be setting an alarm, waking up early, waking up on time to attack the day, just having that mindset really of just progressing every single day. That's what's going to propel you in front of so many other people, okay? That is what's going to push you to that next level, to the past the 90% that fail, and to take you to that 10% or 1% or however many it is that actually are successful with trading. This should be pretty obvious for you guys, but some maybe not. So tidy your room. If your space is messy, then you are going to be messy inside your head. Messy space equals messy head. And you want to have the most level head when you're trading. You want to be making those decisions mechanically, not emotionally. So the best thing you can do is to remove the mess inside your head, which also helps with cleaning your room, okay? If you have a clean room, then, well, actually, to be fair, that doesn't look too clean right now. But you want to have a clean room so that your mind is clear as well, okay? Tidy room, tidy space. Tidy room, tidy space, tidy room, tidy mind. Yeah, that's it. But you know what I mean. So keeping that discipline, all this sort of links to one thing, and that is discipline. So to keep this discipline outside of trading is just really, really, really important, and to take your mind off of things, very, very important. You're carrying on learning here. I would say personally as well, one that I really enjoy is reading, okay? Now, this could be trading books, like Trading in the Zone, or let's say, let me write this down for you actually. Trading in the Zone, or The Disciplined Trader. These both by not Tom Hougaard, by Mark Douglas. And then we have Best Loser Wins. These are some of the best ones. Whoops. Some of the best ones that I have read personally. And then another one is The Zen Trader. That's really good. I like that one. So these are just 4 books. If you haven't read these books, give them a read. While you are, in the process of learning, these books are going to help you massively to develop that great mindset you need to become profitable. So yeah, this is about building a good routine. I hope this makes sense. Let me know your guys' routines. Just let me know, drop me a message on Instagram, say, is this routine good? Drop me the routine. I'll tell you, yeah, man, this routine's good. Or I think you should maybe change this. I think you're not doing this enough. I mean, this is what I needed when I first started, right? When I first started, I wasn't even really putting in enough work as I should. I have in my journal, literally, minimum 1 hour work a day. 1 hour. What the fuck? That's like literally nothing. So like having that accountability from someone else as well, just drop me a message, I'll just quickly give you an answer. Yeah, that is everything on building a good routine. Also, this doesn't only just help build discipline on the charts, but it also helps reset your brain, okay? You have a bad day, you go to the gym, you play tennis, you do your hobbies, that's resetting your brain for the next day. So then you can go into the next day with a clean slate and trade with a level head through the next day. For this last section, guys, I'm going to be teaching you how to journal and why it is so important. So number 1, the importance of journaling is to understand what you're doing wrong. The general idea is that you are never going to understand where you're going wrong and what you're even doing right if it is not journaled, okay? So let's start with common denominators. Now, what does this mean? So it means that there will always be something that you may or may not have done wrong. Sometimes you'll do right and there will be a setup that just fails. That is part of trading. But you will be able to pick up on small details that you haven't been able to realize unless you look at it and analyze your losers to then realize, okay, I'm doing this. For example, with me, when I first started trading with inversions, I would take inversions that would take ages to close and it would be inside of a big chop. Eventually, I did actually realize that and then stop doing that. And that is what increased my profitability, okay? So for this one, it could be trading in chop or low quality inversions. So like how they closed or the liquidity pool you were targeting, or you could even prefer to trade in London. Let's say you have let's say you do prefer to trade London session and you realize that your win rate in London is higher, then you're going to want to trade London more. You're going to realize, okay, this is what I'm doing right. This is what I do best. So you're taking that and expanding on that, you're milking it, right? So I trade good in London, well, boom, you trade London. Or I trade best from 9:30 to 10 is when I have all my winners, and then all my losers come after 10 o'clock. Well, you're going to want to trade at 9:30 to 10 and then stop trading after 10. So it's just stuff like that. You pick up common denominators to alter your trading, and essentially realize how to worm out those bad habits that you have. And even I like to journal what I actually did before I traded as well, to understand where my head was at, and especially with emotions. So let's put down emotions. If I can type today. Okay. So we have emotions. You might go into a trade and you're in this trade and you're panicking. You're thinking, holy shit. Or the best one to do is post-trade recap. Okay, so how did you feel? How did you feel after the trade? Okay, because then if you have a bad day and then you crash out, you're going to realize, okay, shit, I felt shit after that first losing trade. Maybe I should just be taking one setup then. And then that will be like, you realize when you have one loser, you almost like, then you go to take another trade, it's another loser. So you realize, okay, well, my losing days I actually increase, but my winning days I don't. So maybe I should only have one trade when I lose and then have two trades when I win, or something like that. That is essentially the baseline of it. Your emotions, how you feel after the trade, how did you feel during the trade? And now this helps with stuff like closing your position early or moving your stop. This is things that you need to be noting down. How did you react within the trade? How did the trade move that affected your emotions? Okay. How did this make you react? You need to understand yourself better than you understand the market. I can't stress enough how much you need to understand yourself instead of understanding the analytical side of things. So like analyzing the market. Oh, well, I see this and that. Well, actually, your best bet is to just know yourself, so then you can execute a model perfectly instead of emotionally, right? You're never going to execute a model perfectly. That's a silly thing to say, but you get the gist of it, right? Now let's go on to what to actually journal about. Okay, so we've got common denominators, session preference, emotions, and what to actually journal about. Tying all these things together, let me show you exactly how you can get the exact journal I use. Okay, so I am actually going to link my Discord below, but the journal is within the Discord in the free resources tab. Now, let's say you wanted to get that easily. To be able to find that, you go to any post that I have made. Let's say this one, for example, and what you want to do is literally just comment journal, okay? You comment journal and that will send it straight to your DMs. So it will send the Discord link and then you follow the Discord link to get that section in the Discord with the journal within it. Okay, now how do we actually use this journal? So it will take you to Notion. Now Notion is an app which basically is like a workspace, and it's really, really good. It will take you to this page first, and once you've created an account, you should click the link in the Discord and it will take you to this page, right? Kieran's Trading Journal Templates, okay? So once you've got to this, you want to go to here and it will say export as page or like save as template, okay? One of those two. So you want to click that, and then once you've got that, you can have these, you delete this. So we'll show you how to use it, but you want to delete this one and you want to use this, okay? So within this, you'll see a 1 minute chart, 2 minute, 3 minute, 5 minute, 15 minute, 1 hour, 4 hour, and daily. Then you've got the reason for the trade, what went well, improvements, and I'm going to add now emotions. This is where you journal how you felt during the trade or before or after the trade. This is where you're going to journal that. So now we have this. How do we actually do this? How do we actually put in our trades and journal them effectively? Okay, so number one, you want to put in the dates. So let's say for today, it is the 5th of February. So we go 05/02 2026. Okay, win or loss, we'll put in, well, actually you want to delete the brackets as well. So like it looks something like this. There we go. Then win, P&L, you would go, let's say plus $1,000 if you made $1,000, and then what I like to do is add an icon and then put this to a green tick. Okay, so once you've got this, then you need to add your trade. So how do we do that? Coming to the chart and you take a trade. What do? We go to the 1 minute chart. Let's say we use this inversion. This is obviously a bad example, but we would just screenshot this if there was an SMT, you'd mark it out, you'd mark everything out, and then you would put it in here, so like so. And then what you would do is go to the second one. So you need a screen capture tool for this, by the way. I've just started without even telling you that. So I use a screen capture tool, and what you want to do is highlight the entire thing, and then switch back to your journal and place it there. Okay, let me see if I can use snipping tool. So snipping tool is one for Windows, I believe. You go new, new, and then you highlight this entire thing, boom, and then you've got this, you copy, go to your journal, and you paste it. Did I even switch to the 3 minute? No, I didn't, but you get the gist. So you do that for every single time frame, mark out your confluences, and yeah, then you put in your reason for trade, what went well, improvements, and emotions, okay? Then once you've got that, you can go back through your journal and understand the common denominators as to what it is you're doing wrong and what you are even doing right. So that is the course complete. I want to say well done, and I want to say it takes a different type of person to sit through a 2-hour-long course, to take notes and apply that knowledge once they have learnt it onto the charts. So a big hats off to you guys. I have just opened my mentorship program. It is a one-on-one mentorship. I'll be there to help you, guide you through, point you in the right direction. Now this is all well and good, but I'm only looking for serious and dedicated traders, people who are willing to do anything and everything in order to succeed. Trading doesn't require the ability to learn a skill, it also requires the ability to apply that skill, and not only that, you need to be able to progress in other areas of your life too. And that is why I am here, because I have done that exact thing. So if you want to make the change to become a profitable trader, the link will be in the description. Follow that and you can apply for the mentorship. If you guys have any questions, whether that's on the model or about the mentorship, please just drop me a message on Instagram. Even if you just want to talk, just drop me a message on Instagram. I'm more than happy to talk with you guys and give you some pointers. All in all, I hope you guys enjoyed the video and I hope you took something from this. Good luck trading.